$100 a day from trading. Pocket change for some, life-changing for others. But if you stay till the end, you'll discover how to day trade using smart money concepts to hit this target every day. So when I started trading, I had no clue what I was doing. I thought fancy indicators were the key to success. I just wanted to know the trend and find a simple entry point. But I couldn't figure out which way the market was going. It was confusing because different time frames showed different trends. All changed when I ditched all indicators and started reading market structure. This is the foundation of everything we do. A bullish market is when prices keep going up. You'll see higher highs and higher lows. This means each time the price drops, it doesn't go as low as before. And when it goes up, it goes higher than the last peak. When price breaks through a previous high, we call it a break of structure. This is a key moment. It shows the market is getting stronger. Now, real markets aren't perfect. They don't move in straight lines. That's why we need to focus on the swing highs and lows. These are the big turns in price. A swing low is the lowest point that led to a swing high. So when you see a new high form, look back. The lowest point before that high is your swing low. This might sound basic, but it's super important, and many traders get it wrong. They zoom in too close and miss the bigger picture. They might think the market is going down when it's really still going up overall. Let's say you're looking at a small part of the chart. You might see lower lows and lower highs. You might think the market is going down, but if you zoom out, you might see that this is just a small dip in a bigger upward trend. If you sell here, you will lose money when the price keeps going up. That's why it's crucial to map out your swing highs and lows correctly. It helps you see the big picture and trade in the right direction. In a bearish market, it's the opposite. You're looking for lower highs and lower lows. The highest point that led to a new low becomes your swing high. And everything between a swing high and a swing low is just internal structure. It's the small moves within the bigger trend. Don't get too caught up in these small moves. Keep your eye on the bigger trend. Here's another important point. After a break of structure, always expect a pullback. This means after the price breaks through a previous high or low, it will usually come back a bit before continuing in the same direction. Many new traders make this mistake here. They see the price break through a level and immediately want to buy or sell. But the smart move is to wait for the pullback. This gives you a better entry point. Now let's talk about strong and weak highs and lows. A low's job is to make a high. A high's job is to make a low. In a bullish market, we have a series of strong lows. A strong low is one that succeeds in making a higher high. If a high fails to make a lower low, we call it a weak high. This is important for setting targets. In a bullish market, we like to buy at strong lows and target weak highs. Think about it this way. In a bullish market, we are trying to catch higher lows. These are the easy trades, the continuations. In a bearish market, we are looking to catch lower highs. This concept gives you a clean framework for mapping structure and setting targets. Now let's look at trend changes, also known as changes of character. A bullish market doesn't last forever, and neither does a bearish one. In a bullish market, we are seeing higher highs and higher lows. But at some point, price will break below a strong low and form a lower low. This is where the trend changes. Some traders want to see both a lower low and a lower high before they confirm a trend change. That's because sometimes what looks like a trend change can be a fake out. The market might grab some liquidity below a low and then continue up. I like to keep it simple. As soon as I see that lower low form, I consider it a trend change. I then look for the lower high to form so I can trade the new bearish trend. This links back to our strong and weak highs and lows concept. When a strong low is taken out, it means a lot of money stepped in to push the price down. This creates a strong high. We can use this to build our trade ideas. The same applies in reverse, for a bearish to bullish trend change. We look for that higher high, then try to catch the higher low that follows. These changes of character aren't perfect. They will often give false signals because we bet on a reversal. And a reversal is much harder to spot than a continuation. In a bullish trend, you could look for that first bearish change of character, but to signal the start of a pullback. Then you wait for a bullish change of character to signal the end of that pullback and the formation of a higher low. This approach works for both continuations and reversals. After the market structure, the next concept you should master is supply and demand. Supply and demand zones are key spots on charts where big players make their moves. These zones show where there's a big gap between buyers and sellers. To find them, look for quick, strong price moves that suddenly reverse. This shows a big imbalance that made the price jump. To mark these zones, find where the big move started. There are different types of zones to watch for. First are the base zones. These form when price stays in a small range for a while, then breaks out. The edges of this range are where orders build up. When price comes back to these levels after a breakout, it's likely to react. We also have pivot zones. These form at the key turning points, like swing highs and lows. They are often marked by one or two special candles. For a demand zone, look for a strong down candle, where the next candle closes above its high. This shows a shift from selling to buying. For a supply zone, it's the opposite, a strong up candle, where the next candle closes below its low. Considering the price action structure, there are two main types of zones. First are continuation ones. This happens when there's a trend and price pulls back before continuing. These are called rally-based rally zones in uptrends and drop-based drop zones in downtrends. The second type is reversal zones. This happens when price changes trend direction. These are called drop-based rally or rally-based drop patterns. Supply and demand zones aren't random. They show where buyers and sellers are most out of balance. Big price moves often mean there was a mismatch between buying and selling pressure. The key is how long price stays in the zone. When there's a big imbalance, price won't stay long. It will quickly move up or down. So look for zones where price only stayed for a short time before making a strong move. The less the time spent there, the more out of balance supply and demand are. This means a higher chance of a good trade when price comes back. Also focus on fresh zones that haven't been tested yet. When price revisits a zone, it can use up some of the waiting orders. This makes the imbalance less extreme. So the more times a zone is hit, the weaker it gets. That's why it's important to know the difference between an untested zone and one that's been hit a few times. The trading chances are very different. To check if a zone will hold, look for these things. First, a clear break of structure. Price needs to make a strong move away from the zone and break nearby swing highs or lows. If price just hangs around the zone, it might not be strong. And second, inducement. This means there's liquidity in front of the zone that could absorb moves against it. For a demand zone, you want to see buy orders stacked up in front. This could be a swing low or a consolidation pattern. It shows traders are waiting to buy at that price. If there's no liquidity and price just hits the zone, big players might not get involved. To judge how strong a supply or demand zone is, Look at these things. First, the speed of price movement. How fast does price move away from the zone after it forms? Faster moves usually mean stronger zones. Quick big moves show a strong imbalance. Second, time spent at the zone. How long does price stay at the level before moving? Less time often means it's a key turning point. If price just touches a demand zone and starts rising right away, it might mean big buyers stepped in and bought up all the supply. Third, size of the move. How far does price go after hitting the zone? Bigger moves usually mean stronger zones. If price barely moves, it's not a good sign. But a long move in the opposite direction after testing a zone means it's probably important. Fourth, volume. Look for more volume when the zone forms. This shows there's a lot of interest at that price, and big players might be buying or selling there. And fifth, break of market structure. Does the zone cause a break in the market structure? Zones that do this are usually stronger. It takes a lot of money to break market structure, so these zones are more likely to hold in the future. So when you're trading with supply and demand zones, remember these key points. Look for explosive price movements. Find zones where price only stays for a short time before moving sharply. Focus on fresh zones that haven't been tested yet. Check for clear breaks of structure. Look for inducement in front of the zone. And consider how fresh the zone is. Day trading is all about understanding how the market moves, and one key concept is liquidity, the amount of orders in the market. It's essentially how much supply and demand exists at different price levels. Liquidity is what drives market movement. Every day, millions of traders jump in. Many use similar strategies. Buyers, thinking the market will go up, buy at support. They put their stops just below it. Sellers do the opposite. They sell at resistance and put their stops above the highs. Then there are breakout traders. They set buy and sell orders around the range. All these orders create a lot of liquidity on both sides of a range. And why does this matter? Well, it helps you understand how the market moves based on supply and demand. It's not as simple as just buying at support and selling at resistance. You might see a trading range after a downtrend. Some traders, not knowing how order flow works, might sell here. Others might try to buy. And there are still stop orders and breakout trades on both sides. This is where big players come in. Banks and hedge funds trade huge orders, and they need a lot of liquidity to do this. Let's say a big institution wants to sell. They need to free up orders in the market. This is done by triggering stop losses. They might push the price up first, hitting those stops before selling big. And liquidity tends to accumulate in certain areas of the chart. These are often popular patterns that many retail traders use. First ones are old highs and lows, significant price points from the past that stand out on the chart. These areas are like liquidity magnets. Traders often put their stops just beyond these levels, creating clusters of orders. Smart money loves to target these clusters. Major swings, double tops and bottoms, or any pattern with equal highs or lows are prime liquidity areas. Other common spots are triangles, wedges, and flags. So when analyzing charts, look for areas where significant buying or selling orders are likely to be executed. These often coincide with key support and resistance levels, breakouts, or areas of price congestion. Here's the simplest way to find the closest liquidity zones. It's all about recent price pivots, the ups and downs in price that stand out on a chart. A pivot low is a low point with higher lows on both sides. A pivot high is the opposite, a high point with lower highs on both sides. And why do these matter? Well, it's all about how traders think. If someone buys when the price is going up, they often put their stop loss just below the last swing low. If they're selling when the price is going down, they put their stop just above the last swing high. This creates two types of liquidity. Sell-side liquidity, where sell stops pile up below swing lows, and buy-side liquidity, where buy stops gather above swing highs. Big players in the market, the smart money, love to hunt these areas. They place orders to buy below the lows and sell above the highs, hoping to trigger all those stops. Now let's find the closest pivot highs and lows on this chart. We see a low point with higher lows on each side. That's sell-side liquidity. And here we spot a pivot high with lower highs on each side. That's buy-side liquidity. As the market moves, these points change. When price breaks above a swing high, that buy-side liquidity is gone, and we look for the next one. Same thing when price drops below a swing low. We find the next sell-side liquidity spot. Sometimes you'll see multiple swing points close together. These create what we call equal highs or equal lows. They're like liquidity hotspots where lots of stops cluster together. Now let's talk about some key liquidity levels you should always keep an eye on. First ones are previous week's high and low. These are great for framing reversals or as targets for price moves. Second, previous day's high and low. These can also frame reversals or act as price targets. You must also monitor the session highs and lows. These include the high and low from the Asian, London, and New York session. These liquidity levels, plus the swing pivots, give you a roadmap for the market. They show you where big moves might start or end. They are very useful for planning trades within each trading day. Smart money depend on these liquidity levels. They often set up trades around them. If price is going up and nearing a buy-side liquidity level, they might get ready to sell because they expect a lot of buy orders to be triggered there, which could push price up sharply before it falls. On the flip side, if price is dropping towards a sell-side liquidity level, they might prepare to buy. They are betting that all those sell orders will create a quick drop before price bounces back up. When you day trade, you should always aim to take your trade from a discount and premium area. Let's say you have a range, or you have a break of structure, and you mark the swing low that started the move, and the end point of the move. Mark this range from the low to the high using the Fibonacci tool. This shows the middle of the range at the 50% Fib level. We call this the equilibrium. Anything above the 50% is at a premium. Anything below is at a discount. Let's say you want to buy at the middle of the range. If you put your stop at the low and your target at the high, your risk to reward is 1-to-1. But the deeper into discount you go, the better your risk to reward gets. The same goes for selling. If you sell at the middle, stop at the high, and target the low, you have a 1-to-1 risk to reward. But as you get deeper into premium, your risk to reward improves. We are looking at crude oil on the hourly chart. First, we find a range. We have a swing low here. Then price moves up. We mark from this low to this high. Very important, ranges expand as price moves. So as price goes higher, we move our Fibonacci tool up too. We keep doing this until we see a high form. Now, if we're looking to buy, we want to find an entry in the discount zone. Do we have one? Yes, there's a demand zone here. And as price reaches into that discount zone, it moves higher from there. Another range, from this high down to this low. So we mark this one out. From here, we want to see price reach into a premium of the previous range. We're looking for short positions. So we want an entry in the premium zone. Looking left, we have a supply zone. Price reaches into here, into a premium, and rejects the zone. If you want to succeed in day trading, you also need to master inducement. Inducement is simply a move that lures buyers or sellers into the market, creating liquidity pools that smart money players use to their advantage. Inducement can help you spot potential reversals and entry points for trades. Basically, you need to spot when the market's trying to trick you. That's where inducement comes in. It's a smart way to figure out what the market's really up to. So picture this, the price is going up, and it looks like it's about to break through a high point. Traders who like to buy when prices break out will be itching to get in, and anyone who's betting on the price going down will have their stop losses ready to go if it breaks that high. This is exactly when the big players, the smart money, decide to sell. They are betting the price will drop. This is inducement. The market shows you one thing, but plans to do the opposite. First, the big players gather up their positions. That's the build-up. Then, they make it look like the price is going one way. That's the inducement. Finally, they do the opposite of what everyone expects. That's when they cash in. So, when you're looking at a chart, keep an eye out for these fake-outs. If the trend's been going down, watch for a quick jump up before it drops again. That's your chance to sell. If the trend's been going up, look for a quick dip before it climbs again. That's when you want to buy. To find inducement, you need to look for liquidity. We talked before about strong pivots and buy-side and sell-side liquidity. So for instance, when you see equal lows forming a double bottom, that creates a support level. Traders buying at this support will place their stop losses below these lows, creating a pool of sell-side liquidity. Smart money players can use this liquidity to fill their own positions. To profit from inducement, you need to think like the big players. They're looking to execute large orders without moving the market against themselves. So they use these liquidity pools to their advantage. When you see price approaching a strong high or low, be prepared for a potential fake-out move before the real trend continues. One way to use inducement in your trading is to focus on liquidity sweeps. This is when price briefly moves beyond a key level, triggering stop losses and creating liquidity before reversing. These sweeps often occur just before a significant move in the opposite direction. When looking for inducement setups, pay attention to fair value gaps and supply and demand zones. These are areas on the chart where price has moved quickly, leaving unfilled orders. Price often returns to these areas, creating opportunities for trades. In this example, the price has been dropping. Then it tries to go lower, but can't quite make it. There's this pivot high point nearby. If the price breaks above that, it could signal a change in direction. And that's exactly what happens. This creates a demand zone and a fair value gap. And it's like a magnet for the price. It often comes back to these spots. And watch what happens next. Before it takes off higher, price does something tricky. It creates a new low point, getting more buyers interested. Then it quickly drops below that low. This is the inducement. It's tricking people into thinking it's going lower. This is how inducement works in trending markets too. When the price is in an uptrend, look for lows to be taken out before the next leg up. In this particular case, we can spot several potential entry points where the price ran a low before continuing higher. The key thing to watch for is how the price closes around these old lows. If it quickly bounces back after taking out a low, that's a strong sign that the uptrend is still intact. And you need to be patient. If you're looking at a bullish inducement setup, where you think the price will go up after tricking people into thinking it's going down, wait for the price to actually start moving up before you enter. You might miss the absolute bottom, but you'll also avoid a lot of false signals. Market structure mapping will make the difference here. I repeat, inducement works best when it's aligned with the overall trend, or at key reversal points. If the market's been trending up for days, an inducement to the downside at a major demand could signal a significant reversal. In my own day trading journey, I saw immediate improvement once I started using volume profile. Volume profiles are one of the most powerful trading tools. They show how much volume occurred at specific price levels. This is key because it gives more useful info than traditional volume tools, as they only show total daily volume. To use volume profiles, go to the left side of your chart platform. Look for forecasting and measurement tools, and add the anchored volume profile. Then click on your chart where you want to apply the profile. The bars in the profile show trading volume at each price level. Bigger bars mean more volume at that price. The middle line is the point of control, the level with the most trading volume. High trading volume matters because it shows where buyers and sellers had lots of interest. They took big action at those levels. If price comes back to these levels in the future, there might be interest again. This creates potential trade entry and exit opportunities. But don't use volume profiles alone. Combine them with the concepts we talked before, key points in the market structure or supply and demand areas. Start by applying the anchored volume profile at the beginning of a price move. The profile will only calculate data after that point. The point of control shows where the most volume occurred. This high volume zone becomes an area of interest. If price returns there, it could present long trade chances, or it could be a good exit target for short trades. The real power comes from pairing high volume areas with key levels. Zoom out and look for important reversal points that create a key level. If these align with your high volume zone, it makes that zone even stronger. The higher quality the zone, the more likely price will react there in the future. Also, look for other high volume bars that line up with reversal points too. These combos of volume and key levels create high quality zones to watch for your trades. You can also apply the volume profile tool to larger chart areas. This helps find the best key zones across a wider range. Look for points of control that line up with multiple reversal points. These give you key zones to focus on. Now, in my first 2 years of day trading, my biggest problem was trading the wrong trends. I kept getting caught in false moves and choppy markets. One time frame would show an uptrend and another one a downtrend. You might have this problem too. Which one should you trade? In my case, the solution was extremely simple. I simply monitored the 10-period simple moving average on the daily chart. If you need a simple way to filter, buy, and sell trades, just use this simple method. Price above the moving average on the daily chart. Look for buys on shorter time frames. If the line slopes up, it's a bullish trend. Price below the moving average. Look for sell trades. A downward slope means a bearish trend. Price near or crossing the moving average often. Wait for a clear trend or avoid trading. It's that easy. Once you spot the daily trend with the 10-period moving average, use this info to trade on shorter time frames. Monitor the market structure. Find your liquidity areas. Mark your supply and demand zone and confirm this with the volume profile. This way you dodge false signals and choppy price action. You only trade with the bigger trend. This is how you day trade using smart money concepts. You won't get lost in a sea of conflicting signals. You align your trades with the main market flow. And if you're ready for more smart money secrets, go ahead and watch one of these videos.